Okay. I weirdly get like, I'm very comfortable talking, but I'm just worried about messing up people's titles.
Yeah, no, I don't care.
Yeah.
I have like 6 titles. That's why I don't care.
All right, everyone. We are live here recording from Digital Asset Summit London. I am sitting opposite Beth Haddock, Director and Advisor at the Stablecoin Standard. Beth, welcome.
Thank you.
All right.
Good to be here.
I'm really excited. We've got a lot to cover and not as much time as I would wish with someone like you, but can you just give the audience a quick 30-second intro, and then, we're speaking here live from DAS London, so give us your impression of the conference as well as a first follow-up.
Sure. I just came off the stage, and I love the fact that the audience was very engaged. Lots of people came up afterwards and wanted to talk. So I feel like we're at this golden age of a convergence between traditional finance and crypto, and that's my background. I spent a couple of decades in traditional finance, running regulatory compliance programs, and then I really wanted to be part of a new paradigm. So I pivoted around 2016. I was lucky enough to be helping a lot of the A16Z portfolio companies when they first started out in crypto. So since then, I've been a director and an advisor, and I've been pretty fortunate to work on some really interesting projects helping innovators globally. And now, as we round out 2025, lots in stablecoins and payments.
Amazing. Well, that's what I want to chat to you about. And maybe it was such a big theme of the conference this year, especially. One of the most surprising things to me in the last year coming out of the US side has been some of the words that Secretary Treasury Scott Bessent has said on this subject. And, every time he speaks about stablecoins publicly, it's always very positive, but he's got these pretty grandiose predictions around, first it was $2 trillion of stablecoins by 2028. Then it's, 4.7 by the end of the decade. I mean, these are really, really large numbers coming out from someone who's extremely important in the United States, but also has the power to make that happen, right? And it's from an office that has traditionally been highly resistant to that. So yeah, it's been kind of all over the stages over the course of the last couple of days. I'm not sure how much, I know you had your own panel, but what do you think? And I want to eventually get to this idea of convergence, because there's a lot of positivity, I would say, there, but then there's some maybe downsides as well.
Yeah, so maybe I'll pick up on that with the opportunities and the risks.
Yeah,
right?
perfect.
Yeah, so to me, to have leadership in the US and quite frankly, globally, like in Asia, they were leading, even in Europe, having already had laws that then the US with the Genius Act, the legislature had a chance to sort of iterate on it, I think was really great. So we're at this point where we have more clarity, but as you probably know, there's hyper competition, and the traditional banks, there's a lot of influencing and discussions, and we just submitted our own comment to the Treasury Department for the implementing regs for the Genius Act. So I think the leadership's commitment to responsible innovation is not unlike the last administration's commitment to, I think they called it responsible development in the previous executive order, and responsible innovation in the current administration's executive order. And I'm glad to see it. To me, it's part of what we need as we're growing, to make sure that everyone knows innovation isn't going to stop. It's going to keep accelerating. Let's figure out a way to do it in which all of the different users can be protected. But I do think it's a little messy once you get underneath those broad statements, when you look at the hyper competition between traditional finance giving up the status quo, and then innovators understanding that in order to grow, we need to have better operational resiliency, whether what we saw last Friday or just generally as any sort of great innovative products grow.
So, okay, I want to talk about maybe some of the resistance from the incumbents side of things first. So, a lot of, at least with Genius, there's been a lot of discussion around being able to give interest to users, pass interest on to users. And it's been explicitly sort of banned, but there's a loophole that I understand the banks are now trying to close. And the argument from the bank side of things has been, this is going to be really bad for small banks, for community banks, There's a part of me that's a little skeptical about whether or not JP Morgan really cares that much about that. And I'm very curious about your perspective here. How real is, it seems like there are going to be loopholes which allow passing interest back. Coinbase has been pretty vocal on this, but maybe describe what some of those are, and then how real is the threat to, small community banks? Is this true? Does that even matter? How do you feel about this entire, train of thought?
Yeah, so I do think it's true in the sense that change has different incumbents figuring out how they can adjust, right? And you can adjust by trying to maintain your position, or you can innovate and accept that change is inevitable. Of course, where probably you and I sit, we think change is inevitable.
Yeah.
And I've recently been part of a lot of the Genius Act implementation discussions where I do think a large amount of banks understand that change is inevitable. This concept of a loophole in Genius, I smile when I hear you ask the question, because I think of all types of different laws throughout the globe. Let's just take the US, where there's always exceptions and exclusions. And this is no different. So I don't think it's a problem with the law that was passed. I do think the reason why we have the laws and then we have the implementation regulations is because we come to a balanced position, and sometimes exemptions and exclusions are permitted.
Yeah.
And then if experience shows that we didn't strike the right balance, we can adjust.
Yeah.
So think how long hedge funds and private funds are not operating in the same regulatory regime as banks or broker dealers. And that's exemptions and exclusions that we're comfortable with. And we could probably come up with lots of others.
Yeah, I'm sure. One thing that I had never really thought too strongly about was the amount of interest that banks pay to people that deposit into their checking accounts. And maybe it's watching more bank malfunctions in the era of social media, but it was very interesting to see something. It was a big discussion when Silicon Valley Bank was failing around, checking accounts not being protected, but something like a sweep or a money market fund being protected. And that was the first kind of interesting aha. I mean, it is up to a certain point. There's $250,000 FDIC insurance, but if you're a big depositor, it's not quite protected as much. And, I had never really thought that deeply about what is the appropriate, funding rate for banking deposits. And it kind of seems like you know much more about banking than me. I don't. I haven't been checking that net interest margin on most big banks or community banks recently, but it feels a little crazy that it seems like post '08, the amount of interest that gets paid out to depositors is like 0%.
Yeah, so to get to your community bank question and then to address this, which is, I think this is an opportunity for community banks to really sort of engage more with their regions instead of us having these big SIFIs that are really monopolizing with a little m the market. So I do think it's an opportunity. And I think even if you looked at some of the discussions, I think there was one last week with the Fed, that a lot of innovators are focused on that. And I also think that since 2008, it doesn't make any sense. You probably hear this from Gen Z and any of the other generations that are coming post 2008. They don't trust the banking structure that we currently have, because it's almost doesn't make any sense that you give the bank all of your money, the bank uses all of your money, and you don't get paid for that use. But then we're talking about getting paid if you put your stable coins on Coinbase, and Coinbase is going to give you yield.
Right.
Like, it almost intellectually, you can't even follow the train.
Yeah.
So because I spent many years working at banks and being part of the American Bankers Association, I know there are risks everywhere.
Mm-hmm.
This risk doesn't bother me because I do think that as long as we have informed risks and you have responsible innovators and we have the Genius Act there, much more clarity than we even had 2 years ago, I don't worry about it. And I do think we're going to improve on the current system, because for you or myself or for the Gen Zs or others that are trying to get ahead, we want people to have their own freedom of their own money and to allow large organizations to use it and not pay for that. It's almost like the corollary of your data.
Sure.
Like you give your personal data and someone else is using it, and these data brokers and the rest. And there's so many great innovations on the blockchain where you get to have your own data and have it be portable. So I think we're going to see that trend, whether it's in the commerce, money, banking, our own personal data. And I think it's a way that I'm more optimistic about the way that we interact.
Mm. And talk to me a little bit about the small bank versus big bank here, because I actually can imagine if net interest rate margins are compressed, or if the NIMs are compressed, because banks now have to pay out more to attract funding, then I could see big banks that have scale and maybe have a more durable net interest margin being less impacted than the smaller banks. Is that true? Not true?
Yeah, I don't know. The only thing that I would focus in on is, like, to me, this is the moment, right? This is a moment where there's going to be rapid change. So can you be bold as a smaller bank and go all in instead of sort of standing back and waiting and then needing to either rent rails that have been built by someone else or sort of be strapped with having to upgrade your legacy systems?
Yeah.
So I think if one is a smaller bank and willing to be bold in a responsible innovation type way, that wouldn't it be a better dynamic if our banks served local and regional communities instead of being massive global organizations that really aren't necessarily focused on incentivizing small businesses in really helping out entrepreneurs? I mean, the whole next generation, they're more likely, I'm sure you probably even know the statistics,
I was
to
gonna
be
say, you're hitting my
entrepreneurs.
funny bone here.
Right?
Yeah, I completely agree with this. And you know what blew me away? Actually, this was during COVID, and this was when all the stimulus was going out, and preferential credit and all this stuff. And I remember thinking there was this argument going on that big companies were being favored here, and I thought to myself, well, that makes sense because probably big companies employ most Americans. And I looked it up, and that's not true. 2/3 of Americans are employed by small business. And I actually used to write things. We have a great newsletter writer named Byron, but I used to sub in for him back at. Oh, he's the best. Shout out Byron. Matt Levine is the poor man's Byron Gilliam. So, but I used to write. I had this idea about if you look at the number of commercial banks in the United States, there used to be something like 60,000, and it has been a one-way trip down.
Yep.
And the U.S. is still better than most banking industries in different countries. The challenge there, though, and if you talk to people in banking, most of them will say, that makes a lot of sense. That's great. Whenever someone gets out over their skis on risk, someone with a bigger balance sheet steps in and absorbs it. But the challenge there is if you are a small business, and which, by the way, employs most people in the United States, these banks are not set up to serve you at all. They're not interested in you. They don't want you as a customer. And I don't fault them because it's completely rational for them to think like that. But it does open up an opportunity. And I think, right.
Voila.
Yeah.
Yes, absolutely. And it's like two different shifts that have recently happened.
Right.
And the recent shift are the more and more entrepreneurs, which we want, which is really great. And then the consolidation since 2008.
Yeah. I have a question. This is going to sound a little bit like a non sequitur. Do you think banking is overregulated? And here's why I asked this question. I'm starting to see one of the attacks that people used to levy at crypto was it's just regulatory arbitrage. And I thought about that word a lot. And I actually think that crypto is very good at predicting the future and showing market inefficiencies. And I'm starting to develop the view that a lot of markets are highly overregulated, and equity markets are a great example of this. Companies are staying private twice as long as they used to, 15 years. Asset issuers do not want to go public. And I was talking today with Danny Masters. He's the executive chairman at CoinShares, and he was describing, CoinShares was a public company in the UK for 5 years. They recently went public via SPAC in the United States, and it is unbelievable how thorny that process is. And from my perspective, it's like, why are we making it so? We want big, deep, liquid public markets. We want to share the wealth creation. We don't want the wealth creation. So I'm going on my diatribe here, but I'm starting to see crypto fixing a lot of areas where there's overregulation.
Yeah, well, so I'm shaking my head yes, because I agree, and that's why I joined crypto in 2016, because I don't think it's intentional. I do think it's also this change where the laws are from 1934 or
Yeah.
1940, and technology has just changed everything. So some of the risks that we were concerned about can be solved by the nature of the actual technology, as long as the regulators and the leaders understand that technology. That's why I'm really pleased that in the US and actually here in Europe, there's more and more discussion and more requests for comment. We just submitted one this week from the US Treasury about how to fight illicit finance. And the specific question was, give us novel regulatory technology, because I don't know if I would agree it's over-regulated. I would just say it's over-bureaucratic. And then, unfortunately, you end up missing the risk because you're focused in on these legacy manual processes. And the one that to me is most germane to crypto is personal financial privacy. So when I think about Michael and Beth having to give our passports, our licenses, even though you probably have global entry and have already, and like the government has your biometrics, the government has everything they need to know about you. Why do we have to continually become more and more vulnerable to financial institutions by giving our personal information? So that's where it's like, is it overregulated, or are we so antiquated we should be focusing on transactions and wallets, not monitoring people?
It's like you're listening into my private conversations. Ironically,
I haven't, I swear.
Well, I'm this exact example. I've been talking because I lost my passport recently, along with I got a new dog, and in the excitement of going to pick this new dog up, I left my wallet and passport in the car that we rented. 0 out of 10. Do not recommend ever doing that. But I had to get a new passport in a very short period of time, and yeah, it's first of all, if you don't have one form of government ID, good luck getting another form of government ID. But also, I had to fly through to go to the new passport place. I was like, why do I need my passport here? You have all of my. I have a theory about this. If you're open to like a minor conspiracy theory, which is I think that they just don't want everyone to know that they have this much private biometric information on people.
Well,
That would be my
I have
guess.
digital ID, so when I
Yeah.
walk there and I don't open up my passport and the TSA agent says, "Hello, Beth," it's obvious, but I would
Yeah.
love to know the name of your new dog.
Oh, his name is Chonk. He's an English bulldog.
Oh, adorable, adorable.
Yeah, I'll show you pictures. He's
Okay.
unbiased, but he's a cutie. Okay, so I also am big. If I could only pick one ideological issue, it'd be privacy.
Yes.
And I really dislike some of these rules around, lowering the threshold for financial surveillance to like $600 or whatever they lowered it to. Talk to me about, we started this conversation with the pros and then maybe the cons of combining stable coins and CeFi. And, one thing, having been to DC now a good amount, it seems like no one is particularly interested in sticking up for privacy. Correct me though if I'm wrong on that. And then also talk to me about the drawbacks of there's all this great stuff. Our TAM is going to expand. We have the blessing of the regulatory apparatus, but what are some of the drawbacks that you see in your mind?
Yeah, so I started my career on Capitol Hill.
Yeah.
So I understand that there are so many stakeholders and interests there. So it may feel like it's not a discussion, but I would say if you could have every single podcast talk about personal financial privacy,
really?
I think you should do that.
Yeah.
Because wherever I go, I talk about it because I feel like it's the year of the killer app of stablecoins.
Yeah.
But in 2025, we've been talking less about it than we should.
Yeah.
But not that it's any less important.
Yeah.
So for the stablecoin standard, we do have standards by way of example for DeFi stablecoins as like, let's self-regulate to make sure that the stablecoins don't need to come under the Genius Act, but that they're operationally resilient and they deliver what they promise if they say that they're going to be stable and they're going to hold a peg. And I do worry that 2026, when we get to DeFi, if we don't continue to highlight the need for financial privacy in either an economy that's volatile or a government that might be corrupt, that we're going to lose an opportunity. So please keep the conversation alive.
I will. I will try. I have a. I keep talking about my own theories here, but I'd love to try this one out on you because there is a story about pretty good privacy, the standard. Back in the '90s when the government thought classified encryption as weapons grade technology, and what got them over the line on not having that be the case was not some sort of ideological argument to be won. It was there's a business case. Businesses want transactions private, and so my thought on this has been what will succeed here and who we should actually be lobbying is not politicians, it's business leaders. Because if they're going to bring things on chain, and you can see it here, there are examples of RWA focused L1s and privacy is built in from day one. And my more positive spin would be I think actually institutional adoption will fix the privacy problem in crypto because no one is going to be comfortable with all of their transactions. Businesses won't be putting that all out in the open.
Yeah, well, it's smart business to whether you call it privacy by design or only collecting what you need. And as a business, if you do not collect the information, then you're not accountable for all of the friction that comes with protecting it and dealing with incidences and breaches. So I do hope that there are those economic behavioral incentives that end up solving the problem. But I feel like it's such an important issue that we should do both lanes at the same time.
Yeah. Okay, final question for you here, and then we can wrap up. And I would love to, if folks want to hear more about the work that you're doing at Stablecoin Standard, please just drop a gentle shill at the end of the podcast. But so this is less about genius and more about clarity. But I'm just curious, is it still a very bipartisan issue around crypto in the United States at the moment? Because it seemed like, the last I listened to Jake Chervinsky and all of this stuff from shout out Jake, he's great. And I was reading a tweet thread from him, some of the recent pushback on clarity. And it seems like a lot of folks, including Hayden from Uniswap, who are always very in the middle, saying we need to build a bridge to both sides, or kind of actively just saying the Democrats do not want DeFi in the US. And I'm just curious, what's your sense from probably speaking to this contingency more than me? Is it still very, is it a partisan topic or what's your thoughts here?
So you may accuse me of being an optimist, but I will still be an optimist at the end of this, which is like when I look at Genius and how the Genius Act was passed, I think we haven't talked enough about the bipartisan effort of Senator Gillibrand and Senator Loomis. And so I am going to optimistically hope that we do the same. This should not be a political issue. But with the midterm elections coming up and with such a massive year one of the new administration, I do think that it is a political moment. Let's just hope it passes. And I have had lots of conversations, bipartisan conversations. So I don't think we should give up and assume that it is just one party that cares about responsible innovation. And even just my reference to the executive order under the last administration, it was the same sentiment, but it was like the next level down, and then the fear, and we had FTX, et cetera, that we got off kilter.
I agree. Okay, well, Beth, this has been a really, really fun conversation for me. I agree with so many of your takes. So it's just been total fun. If folks want to find more about the work that you do at the Stablecoin Standard or just follow you or whatever, what's the best way to do that?
Yeah, so you can follow the Stablecoin Standard. We have a website. We have our own global standards. We have a big announcement coming out tomorrow about a transparency index. So this way you can really rank your stablecoin, and you can find me on LinkedIn or Twitter.
Okay, awesome. Well, Beth, this has been a ton of fun. Thank you so much for talking to me today.
Thanks for having me.
product. It's kind of like using an old product and into the space, but they found a way. I think that also will drive a lot of adoption, and that's why it's taking some time, because they haven't really found the sweet spot, some of them anyway.
Yeah, so that the answer to that really involves thinking through the RWA stack. So just drawing out the RWA stack on Solana like a few days ago for something else. But if you think about the number of activities that is involved in picking up an asset and taking it on chain, of course, tokenization is just the start of the journey. Even to get there, you've got to have transfer agents lined up. You've got to have all the regulatory wrappers. And of course, you also need to make sure that the token mechanics that you're using is kind of viable for DeFi consumption. So that's the upstream. And then you also, if you're going to go DeFi distribution, like if you're going to use a platform like Camino, the ideal form at this stage is going permissionless. So there is a bit of legal compliance and tech operational angle to that. So that has to be built in. And then you have to think about price feeds, proof of reserves. And once you have lined all this infrastructure element out, then you start thinking about liquidity. Who is going to be the first investor to take the asset on chain? Who is going to be the investor who is going to be providing lending opportunities for this asset when it's used as collateral on chain? And who's going to provide DEX liquidity? How are you going to incentivize the whole launch? So tokenizing an asset is just the starting point. It's not the end stage. It's just the starting point. And if you really want to prove that an asset has actually got legs on DeFi, there is so much more involved. And it is a journey. And a lot of these actors, or a lot of these capabilities, capabilities along the stack is still being built, right? And that's the fun thing here. You're actually living through this massive transformation of financial services, and you're being part of it. History is happening here, and it takes time. It's a journey.
Victor, how are you thinking about the?
Yes, I think first to give some stats. Back in 1991, the use of cloud services was approximately 3%. After 30 years, you would think, okay, everybody's using cloud. Actually, cloud, from what I see from the latest research reports, is approximately under 60%. And that's shocking, right? So these takes.
And it's the same with e-commerce, right? Like you think e-commerce is everything. It's not, right?
It's
like
not.
regular commerce is still much larger than e-commerce 20 years
So
ago.
here I give it to I blame it first on a time factor. That is a common denominator. If you start spying on everybody's phone calls, the common expression is, I have no time, I'm busy, right? We're sacrificing time with our kids, with our partners and everything, just to get more work done, even sleep. So I say that's one which is very important. It has nothing to do with technology. Second, I blame the engineers. A lot of engineers here, they talk about Kubernetes and layer 1, layer 2, proof of work, Look, when I use Apple Pay, I don't give a shit about what's the 7 steps behind. Is it cheaper, better, faster? Then I'll pay for it, right? So engineers and narrative, it's another problem, right? They get too technical, the TPS. Look, the end user.
There's none in the audience.
Yes.
and spoken like a true product guy.
Ironically, engineers are the smartest. I didn't know that storytelling was a talent until I arrived in the DeFi ecosystem, because no one could tell a simple story, because all you have is 30 seconds elevator speech, right? Everybody's ADHD. We can't stay focused for over 2 seconds in the same user interface. So narrative is one thing. You can blame also the regulators, the lawyers, et cetera. But I think it's the narrative, and last but not least, also a little bit of complacency when we don't have time. Why? Private markets, for every bank and private wealth, they're having the best years of their lives. Crazy AUM, crazy inflows. And when it comes to private equity and private bank, everything's about raising money and deploying, right? Operational, the rest, I don't care. In order for me to do blockchain, I have to open a book that I've never opened up after my master's or undergrad. It's very difficult to reuse your brain and take extra time at night and enroll in MIT, Oxford courses for a blockchain that is not worth very much. And you need to compete with guys that are trying to sell you a pixelated JPEG at 1 ETH, right? This is how life is changing. It takes time, and their lives right now, when you're at like mid-40s plus, you're not incentivized to halt operations, use extra time, risk your marriage and your sleep. and do something that will hinder your bonus payments, etc. So I think it's a mix of everything, but just to make it a bit controversial, as engineers, I blame you guys. You guys are smart, figure it out. And second would be, just human behavior and incentives.
What do you think, Randy? That's hard to top, but
I know. We'll see what I can do. But I think that it's still so nascent. I mean, right now, if you set aside stablecoins, it's a little over $30 billion of RWAs on chain. I mean, compared to hundreds of trillions of dollars of actual assets. So it's tiny, tiny. A lot of it is kind of money market funds, which I think is a good first step. But I think the real value comes when other assets come on chain. And a lot of these are not digitally natively issued, which is critical. A lot of it is traditional assets go into an SPV. You tokenize the SPV, which creates its own set of inefficiencies. So for example, if you tokenize equities that way, what do you do with corporate actions? What do you do with voting? So I think that there's a lot of maturation that needs to happen. I think some of it is there's been lack of regulatory clarity, to say the least, in the US. I think it's becoming more clear. It's not perfectly clear. That will need to happen. But then I would just draw one other example. When you think about the time it took to electronify the capital markets, it really started in the late 80s and ramped up in the 90s. Today, we've reached about 90% electronic markets. Some markets like fixed income are still only 60% electronic. It took equities even, which are well suited for electronification, at least 10 to 15 years to get to 50% electronified. And I would say that blockchain enabling the capital markets is a much bigger change. It's a more impactful change. But if you think about rewiring the operating system of the way capital markets works, it's a much bigger change than changing how orders are handled, orders are matched. This is like the back office processes that are being fundamentally changed. So I think it'll happen within that sort of time frame, because just the pace of change is just ramped up. But I think it'll be huge when it happens, but it's going to take time. And I think I just pick up on one thing that Sebastian said. I think transparency is another wonderful example of all this, and I think it's great to save operational costs, especially when you get into more complex structured products, CLOs, things like that. It adds a lot of efficiency, but I think a lot of the larger capital markets players are making tons of money on the opacity. That's one of the reasons why a lot of the markets, a lot of the traditional huge markets like derivatives and fixed income are much, much slower to electronify, because the banks have benefited from sitting in the middle of the market. The markets are opaque and they make tons of money with that. So if you then take that away and say, let's make that all transparent, let's make everyone equal, that is not good for banks. So they have all the connectivity, they have the distribution. Eventually they will be forced to come around, just like they have with electronic trading, but they will drag their feet. So that's another, I would say, less obvious friction.
One thing I'll add is to say something positive on the moves from like the traditional players, is that they, and this is something that I've been surprised about in the discussion that I've had with them in the past couple of years, is that it's not they're just sitting idle and not doing anything about it, right? Like they all have plans and teams, and very brilliant teams that are like ready to do big things. To your point, it's going to take time, but it's not like they're just waiting and saying, well, we'll put this and we'll look at this when it's ready or when we have the regulation. They're ready, like not fully ready, but they're like getting ready for it. And I think that's an important thing to take into consideration.
What about from an infrastructure perspective? Is the infrastructure there? What challenges exist still?
Well, so I'll speak obviously from my standpoint, which is really around security and making sure that when I was talking about the PSD aspect, a big part of it is, can this be secure? Right now, like the ETF, for example, is really easy because it's not really on chain. It's like it's basically a product that you're doing it the old-fashioned way. Like, are you willing to hold Bitcoin on your balance sheet? And if you do that, what are you going to do with it, right? Like, how do you secure it, etc. And I think that's one of the things where you need the tools, and they have to be obviously the gold standard in terms of security. I think they have to be very close to what they're using today. So, for example, like we use HSM technology, which is something that is being used by traditional custodian. So when we talk to them about doing it for Bitcoin or for ETH, et cetera, they understand because it's like the setup that they already have. So you're talking the same language kind of in a way. So on the security aspect, I think that's what we're trying to do, right? Like build something similar to what they've been using so that they don't need to relearn everything. So from my standpoint, that's more important.
And I think to carry on to Sebastian's point, I think that ultimately banks are going to choose a lot of the value chain that they're going to want to insource and control. I think that'll certainly go to custody. That's something that's very comfortable for banks. They have the brand, the reputation, the balance sheet. So that would suggest that they're going to want to use custody technology. So that would be like a Ledger Enterprise or a Fireblocks versus outsource that to another digital asset custodian today. I mean, I think they'll have other sorts of clients, but I think that banks will want to have that and control it as they build products on top of it.
Just to add, we're looking at it very much from a TradFi perspective, but there's also a DeFi angle here, which is the DeFi platforms out there. They'll also have to start embracing some of the standards that TradFi have set for themselves. Those rules and regulations have been there for a reason. And personally, for me, one of the things I'm deeply proud about Camino is not just today. I'm not saying this just to shill the platform, but even back in the day, like 2 years ago, just after FTX, whenever there used to be a liquidation event in the market, the CEO used to come out and talk about how the liquidation engines have performed very publicly. Most other platforms, DeFi platforms back then, they would be shilling the yields that they're able to produce. But the moment there is a liquidation event, they would shut up. Whereas this organization would shout out about how risk managed they have been. And even today, this across chains, across lending platforms, we are the only ones that offer a real-time risk dashboard looking at risk metrics across 12 different dimensions. You can go to risk.camino.finance and see it live. The reason I say that is not because Camino does it alone, but that's the culture we have to have on the DeFi side. As Vic said, TradFi do not have to compete with NFT holders and NFT regions. There is a space for that, absolutely, but there's got to be a space where people can transact on chain safely and feel comfortable doing that. And that's a journey. It's a cultural shift. It's of course, from a legal and compliance perspective, there's quite a lot needs to be clarified, and there's got to be a lot of work done there. But also from a DeFi standpoint, we've got to embrace some of those aspects.
Well, and I think, once you get through the regulatory clarity, I mean, I think that what will happen with DeFi is it will become the back office for a lot of what's happening, because there's a huge number of activities that banks do that you do not need an office tower of people to manage. There's many use cases that could be handled programmatically on chain, transparently, cheaply, instantly, and I think that'll migrate there. We already see it in kind of the borrow lend marketplaces where, like, if you want to borrow against your Bitcoin, it's, if you go to a centralized party, it's 10% plus. On Aave, it's 5-6%. So it's way more capital efficient. Like, you couldn't even get wholesale funding against Bitcoin, less than 7-8%. I think that'll probably come down over time.
It's free on Camino, cheap shill.
No, that's what I'm saying. So I think that we'll see more relationships like Coinbase Morpho. I think Robinhood just announced something like that. But I think for the average user, that's how they'll touch DeFi. It'll kind of disappear into the background. There will always be the more crypto forward retail people that are looking for the newest things. It's going to go to the web interface. But the average person, like, I always think about my mom or dad, are they going to go to like the Camino dashboard? Probably not. But they would, if JP Morgan had a Camino market on through their Chase app, they probably would use it and they wouldn't even know it, right?
Victor, how are you thinking about infrastructure?
Whether the infrastructure is ready. Again, another, just to make it a bit more fun. As long as we have 90-year-olds, 80-year-olds, and 10-year-olds, the infrastructure would never be like harmonized or standardized, because a 90, 80-year-old will never use a MetaMask or a Phantom wallet, right? They like the trust factor. They like the relationship manager, the financial advisor. Now, there's a life story where a bank owned by a family, it's a private bank, very successful. They've decided to take this path of staying class. So no digital, just, Napa Valley, Basquiat events, and, really like for the VVIPs. Now, all of a sudden, they start asking their clients, hey, your son and daughter, why are they not showing up recently? And this is to the point to say that infrastructure is not ready yet, but it will change. And the answer was, they say you suck, right? And they're like, beg your pardon. They say that you suck because first, you don't have an app. Number two, you don't have any crypto solutions. And they just hate going to these wine parties, and it's a waste of time. They are doing everything with their app. And the fact that you don't have one for them is a waste of time. You're too expensive. And this ties with this one of the most recent powerful research analysis that has been conducted, in where we're living in the biggest, greatest generational wealth transfer that the human history has ever seen. Now, 81% of the recipients answered and stated that as soon as they inherit their assets from their parents, the first thing that they're going to do is fire their financial advisor. Why? The first wallet that they had was a Revolut, or was an app-based account. Now, think about, you ask them to go and open up a bank account in a, retail high street. You have to wait a few hours and paperwork. They get shocked, right? So for them, the risk of embracing the old infrastructure, they would never do that. Everything has to be instant. Like, they need to have everything in one place. Again, ADHD is not even a disease these days. It's like oxygen. I mean, everything has to be atomic. So the infrastructure with these users would take for granted all of this digital atomic set on transparency, et cetera, et cetera. I think all of the custodians, they will adapt to it. Heck, and this is a good segue for the last question, and I'm sure Ledger would love it, is like, at some point, everything will be on a self-custodial base, right? And people may not know, but that's where I think the new generation will kick in, and every company has to have a strategy for the future, now for the 90, 87-year-old, but also for what's next to come.
I mean, what's interesting is that it's a cultural shift that's very wide, that goes beyond finance. I mean, finance, obviously, what we're talking about, it's a great example. And your Revolut example is on point. Like, all of my kids have Revolut accounts, and they will never go to my bank. And I would, and if I could, I would do the same, because when I use Revolut, for me, it's so much better than any other app that I've seen. And it has crypto like built in, right? Like, you buy Bitcoin on Revolut with one swipe. But the cultural shift, I think, goes beyond, in the sense that it's the same kind of thing that you used to, give your health to like your doctor, and like you wouldn't see your blood results, et cetera, et cetera. It's like, oh, he's taking care of it for me, and your financial advisor is taking care of your money. And think we're at and I will get the news from like CBS because I trust it, et cetera. And then that trust is like gone, because you're realizing that you can learn on your own, and you can know on your own. And so you want to know about your health, you want to know about your finance, you want to know about your news on your own. And I think that's the cultural shift that's happening. That's really big.
One more funny anecdote. It's slightly off topic, but just on the whole point that we're making with Revolut, my 18-year-old, when she has cash, she's like, I think that feels like fake money. She doesn't believe it's real money until it's on an app. She's like, it's easy to spend because it feels fake. It's like, well, it is a little bit.
Credit card bill. I agree.
It is a little bit, yeah.
It is a good segue into our last question, though. So, we covered the use cases. We covered why it's taking so long. What will it look like when Wall Street is onboarded on chain? We'll say, I guess, what are you most excited about in the RWA space? Maybe we can start with you, Arun.
For me, I think it'll be aligned with what the new generation is all about: instant gratification, right? So from T+2, we'll have T in terms of settlement. So it's not going to be we send money somewhere and they have to wait a couple of days. We do a transaction, and for it to settle, we wait some time. So that's kind of, and it unlocks a lot of capital efficiencies, right? So I think that's the kind of the gist of where we're heading. But I would like to be in a place where I can sell a part of my mangrove in India and buy a part of Buckingham Palace here, right? So that's the level of tokenization that we should be aiming for, irrespective of the liquidity profile of assets, irrespective of where the assets are, what the form of the asset is. But on a more grounded basis, I would like to get to $100 billion of TVL on Camino.
Victor, what do you think? Where are we headed?
Everything will be money. Everything will be cash. Everything will become a payment method. So in concrete, RWA is real assets. Sometimes I call it the real worst asset because it's so hard to tokenize. But that's already happening. Next in line would be NBA. Stands for non-bankable assets. So music royalties, art, sports, everything that is non-bankable. In where everything will be represented as a payment method. So everything will be money, and this will be like internet, capital markets, internet money, and it's a pure democratization to the max. It's atomic, transparent, and it will be hopefully more trustworthy, and it will grow the entire pie size. Great innovation.
Ladies and gentlemen, thank you so much for attending. I'm sorry to tell you that the votes
So
are now
I agree with
closed.
that, with all of
Please
that.
make your
I would
way
just say
back to
one of the
the
other themes that I
votes
think is really
are
interesting
closed.
is the prospect
Please
for
make your way
AI and the
upstairs.
agentic economy. It's one of the focus areas for our next fund. But if you think about, once you have RWAs, everything instantly settlement, you have stable coins. I think there's a huge amount of latitude. Once all that infrastructure is in place, I think that there will be agents that will act on people's behalves that will replace at least part of what financial advisors do today. I don't think humans will come out of financial advice given the emotional piece to it, but there's a lot that could be automated, risk managed, probably much more optimally than is done today. And having all of the assets on chain in a programmatic way is the first step to doing that. I still think that's a few years off. But I think that's something that will certainly emerge over the next 3-4 years, given the rate of change that we're seeing across crypto and AI. And that's something that I'm actually super excited about.
I'll totally second you on that. And the fact that actually there's this very strong link between the two, because right now, if I want to give an agent access to my bank account, it would be next to impossible. But if I want to give him access to a wallet where I put a little bit of crypto and then have the agent do things with it, it can, right? And people have done experiments with it, like have agents make money for them, etc. So that is a use case that exists today, right? That probably will get democratized, etc. But I fully agree with you on that. I like this idea of thinking that, because I think it's part of the ethos of the industry at the beginning, is that it's going to be fully global, that there's going to be like interoperability across like the different chains and access to like the different markets, which is really important as well, because we've talked a lot when people used to ask what is the use case. Well, the use case is that there's 2 billion people that are unbanked in the world, right? So giving access to all of that, and I like your idea of like the growth in India, is also like a way to bring in a lot of people that currently don't have access, and maybe to level the playing field a little bit, to give them access to things that they don't have access to today. And then I love this idea of keeping, so we're talking about transparency, but also privacy, because those things are human rights. They're really, really important. And I think that in this new world, people will be able to have both, right? Like transparency and where the transactions are. But if you want to keep, remain private, you'll be able to keep that privacy. I think that's really important as well.
So Sebastian, I think it was you that mentioned the institutions are there, they're ready, they're thinking about this. We've talked about the infrastructure. Victor, you said the infrastructure is there. I mean, what's the next catalyst for driving Wall Street adoption? Victor, do you have
Engineers?
No, regulations.
Yeah, regulations.
Regulation. More use cases, scale. No POCs, but real native. Yesterday, somebody mentioned no more a replica. It has to be native on-chain use cases that have really proven to be cheaper, better, faster, without twisting the story. It has to be just so self-evident, just like Apple Pay. Yep.
And I think corporate adoption is an important thing as well. I think that, when we talk about the Genius Act and we talked about stables, what we should be seeing is people that are not in crypto space today going into it. So I'm thinking always of Amazon, because if clearly saving $2-3 billion in credit card fees by issuing like an Amazon coin and then giving you an incentive to use it instead of using dollars, I think is huge. And that I think will also like spearhead and then maybe like them having some of their treasury in Bitcoin, right? Like we at Ledger, we have a big part of our treasury in Bitcoin. And I think that more and more corporates will do that as well. And I think that they're the clients of like the bigger banks. If they start moving towards crypto, they will also force the overall ecosystem to like adopt it. So I think that could be something that would move the needle in some ways.
We only have a couple minutes left. I want to give everyone an opportunity to answer this last question. So we'll say 5 years out, what are you most excited about when it comes to Wall Street on chain? Are you ready, Randy? Do you want to start? We'll go down.
5 years out. Well, like I said, I think there'll be a lot more going on with AI. But I mean, I think that from the perspective of the capital markets infrastructure, like I said, I think it's going to take 10 to 15 years to really rewire most asset classes and have it actually have the scale and liquidity that we see today. So 5 years from now, I think we'll be partially along that way. I mean, you see most of the studies that are out today project, I think it's 15 to 20 trillion of assets on chain by around 2030. I mean, that's probably correct, plus or minus 10 trillion. Again, if you think about that in the scale of all assets, which is hundreds of trillions of dollars, there will still be a lot more to go. But I think that even with that amount on chain, there's a lot of these use cases that we're talking about will be able to come to life. But obviously there will be more to come in terms of the liquidity perspective of it.
What I'm excited about is for the industry to grow up as a whole, and that I hope that we put in the rearview mirror a lot of the negative things that have happened in the past. And I think a lot of it goes to having very strong foundations, security being obviously one of the key ones. So what I hope to see in 5 years is obviously all the inflows, et cetera, but like in a space where we're not talking about scandals and this and that, or deep pegs, et cetera, but well, this is here to stay. I think that's really important.
Those inefficiencies are where money is made. But from my perspective, I want to be in a place where we don't talk about blockchains, protocols. We don't talk about TCP/IP when we use our internet anymore. So we've got to get to that place as soon as possible. And I've seen technologies, particularly payment technologies in India, scale massively. So but in a matter of 5 years, I went from paying in cash and a taxi driver turning around and said, "No, I don't accept cash." That is not too far away if we use stablecoin as rails, and there's so much that could exponentially drive the growth for us. I think that's what would be awesome.
Save best for last. I'm sure a lot of we see a lot of young and not less young audience. So a lot of you have missed the internet, the .com bubble or opportunity. A lot of you also have missed the COVID RNA train, probably. What excites me the most is the blockchain and AI. Look, everybody talks AI. I don't know how many really understand, but blockchain is real. It's more immediate. You can do good, make money. So socially, commercially, it's an opportunity for you to stay in whatever you do, representing here finance, but it's applicable everywhere. So my asset class, 50% from for this to be democratized by retail, but also by the digital natives. So that's what excites me the most.
Great. Thank you all so much. Thank you for joining us. Sorry to the engineers.
Thank you.
Okay, everyone. That was a great conversation. Just a reminder for everyone that came in to put on your headphones. This is the last session of today and of the Digital Asset Summit, and we're finishing with a very interesting one inside the Goldman Sachs Digital Asset Playbook. So help me welcome to the stage Michael Ippolito from Blockworks and Matthew McDermott from Goldman Sachs.
No one saw. There was. Matthew, welcome. Thank you so much for joining us today.
Thank you very much for having me.
Yeah. Really excited here to close things out with you. And maybe we've got a lot of ground to cover in only about 20 minutes. So before we get into it, though, could you just give a really quick 30-second introduction to yourself and the work that you do at Goldman?
Yeah, sure. So I've been at Goldman now. This is my 20th year, believe it or not. You wouldn't have thought that. Yeah, exactly. And I've been running the digital asset business for the last kind of 5.5 years, which, as you can imagine, has had a lot of highs and lows, but feel like we're in one of the highs at the moment, which is great.
I was gonna say, very few gray hairs for 20 years and 5 years of digital assets. You're doing
It's not died, I hasten to add as well. Yeah.
Okay, can we just start out? I want to end with where you see this market going and sort of the state of institutionalization, et cetera. But could you actually just maybe use as a jumping off point, what's going on the Goldman front these days? I know there's a platform on the tokenization front that I want to talk to you about, but just give us the high level state of the union.
Yeah, and then some of you may have kind of heard this before, but I mean, we kind of really have digital assets dissected into kind of 4 core areas. One is the crypto part of the business. So we try to be as active as we can in every product that we're able to trade. And obviously with the movement in the US kind of legal and regulatory kind of space, hopefully that's going to broaden, but we're kind of all cash settled products. And as we see the market become more kind of institutionalized, there's just more demand for kind of different products. So you got the kind of crypto trading, which is a global endeavor, big focus on data and content as well in that part of the business. We also have the tokenization kind of part of the business, obviously another kind of topic du jour. So they're a big focus on kind of different tokenization initiatives. We developed, as I think many of you know, our own digital asset platform, which we're still very kind of focused on divesting that kind of next year, middle of next year is still the plan. And then there's also kind of the use of distributed ledger technology for kind of collateral mobility. And as we start to see with kind of more use cases for kind of stable coins and tokenized money market funds and other things and 24/7 markets, collateral mobility is just going to become ever more kind of key. So that's kind of that part of the business. Then there's kind of the classic banking part of the business, which really kind of manifests itself in 2 ways. One, we've made a number of investments, strategic investments, which again is a little bit of a microcosm of the market because you've seen a lot of kind of M&A activity even amongst our portfolio. And, kind of naturally kind of folks have aspirations to go public. Some have announced that publicly. And then we work very closely with our kind of banking team, who, the market is just kind of night and day over the last 12 months in terms of, kind of traditional M&A and capital market activity. So we're very involved there, just given our presence in the ecosystem over the last kind of 5+ years. And then finally, digital money, big focus, kind of many threads to that, but stable coins, obviously, again, big focus, as we all know. And also we've invested in a company called Finality. So also looking, quite closely to kind of central bank digital money too.
Can we take that maybe in reverse order and ask about, the money side of things? And, we had Nigel Farage come here today to talk about maybe some opposition to central bank digital currency and digital IDs. And I'm just curious, maybe on, in the UK market specifically, do you see something like a central bank digital currency taking off versus stable coins? Do you see them being complementary? How do you view that?
Yeah, no, look, it's a good question. I would say a lot depends how you define central bank digital currencies. And I think Nigel's probably, kind of thinking perhaps more along the lines of the retail central bank digital currency, not wanting to put kind of words into his mouth. I guess where we're kind of more focused is on a wholesale solution. And I think Finality is really focused on that. They're already live with the Bank of England. So it's something that, is there. And I think given where they sit, when you think about kind of money, they're the M0 layer. So they're that central bank settlement layer. Stable coins will be just very complementary. They're kind of M1. And so, for us, I think the two can coexist. Stablecoins, obviously, probably more accelerated, are going to have more market presence. But I do think you get ubiquity, scale, and a slightly different risk profile with central bank money.
And can you just articulate the difference between a wholesale versus a retail approach to CBDCs?
Yeah, well, retail, by definition, is something that's designed for retail.
Yep.
And I guess, the theory there is that you can have kind of great oversight in terms of how they spend, what they spend it on, et cetera, et cetera. When we think about kind of a wholesale solution, that's more for kind of capital markets activity. And there, the structural design is one where actually you deposit cash at the central bank and then you tokenize that.
Got it. Okay, let's talk a little bit about M&A. And this is actually something that we talked about, the merging of the equity market and crypto markets to some degree, especially in the United States at the moment. And a little bit about, the IPO window, but we didn't talk a whole bunch about private M&A and kind of consolidation in general. So I'm just curious, when you look out into the market, maybe putting your more traditional banker hat on here, what are you seeing out there?
I mean, just that, right? I mean, I think you've seen a lot of companies kind of grow over the last 4 or 5 years, probably more latterly with very little access to liquidity. And as the market continues to grow, there's still kind of naturally only space for so many companies. And so you are starting to see that a little bit in the exchange space, but kind of across the ecosystem. Market Data Ventures is another good example. A company we'd invested in, Coinmetrics, got recently kind of acquired. And so I do think, even when we look at the digital asset treasuries, obviously something, the number that's spiked publicly this year has been pretty astonishing. And so, as you start to think on the forward, it wouldn't surprise me if we see some consolidation there as well. So I just think it's a natural evolution of the market as it, becomes a bit more kind of, dare I say, institutionalized. And you probably just have, kind of the merging synergies in costs and things like that. So that's something that we're definitely seeing.
Yeah. There's obviously DATs, as a major sector there. Any other sectors in particular? And just one observation of mine, just watching the market over the years, is that it seems like there tends to be the sequence of a bubble in funding in various categories, like custodians and kind of prime brokerage was one over the years, infrastructure more on the crypto side of things. And it takes a little while for that to play out, but consolidation happens after, when the money kind of dries up because returns don't materialize. And so I'm curious, are there any sectors outside of DATs, that feel particularly ripe here, or is it just kind of across the board?
Well, I think a really good example is custodians, actually, because you think there's a lot of digital asset custodians. We've got 2 in our portfolio, fantastic companies. But there you've also seen the emergence of Citi, I think, who spoke earlier this week. BMY, I'm sure, spoke as well. And so you're starting to see a lot of the traditional players also enter the field with large balance sheets, probably more risk appetite and tolerance. And so naturally, you think that there will be consolidation there.
Yep.
I don't necessarily think you need a spark, of a lack of liquidity. I think actually what we've seen, or what I've certainly seen this year, is, companies, kind of well managed, but still the revenue pie probably kind of growing slower in certain sectors, and therefore just makes sense to consolidate, streamline the costs, and have a stronger business.
Yeah. And the last or the first area that you mentioned is the tokenization platform. And I actually maybe would start with the question of, do you think that for the most part, Goldman, are you building your own technology here, or are you leveraging crypto providers? And I saw an article come across the Newswire either today or yesterday that BlackRock has used Securitize as a partner, but now is going to be developing their own technology in-house. And I'm curious, because I think a lot of kind of infrastructure plays in crypto are kind of counting on the holders of assets and providers of institutional liquidity to come in and they can act as a partner. And I'm curious to speak to someone kind of sitting on the other side of that equation and think, are you going to be using crypto solutions or potentially building your own?
Yeah, look, I mean, we've been very vocal about this. I mean, we've been working very closely with digital assets.
Yep.
We're very excited to see, kind of the Canton network and see the momentum that's kind of been driven there. So, we've been users of their software, and that's helped us kind of develop our own digital asset platform. And, as we look to see how the regs evolve and how we see, kind of our future journey, that excites us. This also plays into another theme. When you think about, we've talked a lot about kind of private networks. This ability to actually kind of be active on a public blockchain, albeit where you actually have privacy at the core, I think for us is, naturally a key focus.
Yeah.
So I think, that's kind of been our modus operandi.
Got it. And I'm sure we heard from some folks from Canton, and shout out, thank you for sponsoring the conference as well, Canton. But I would love, could you just, for folks who might not have heard some of those chats, can you just give a quick overview of what that platform is and why it appeals to Goldman?
Well, there's kind of two components. I mean, when we kind of developed the digital asset platform kind of way back, it conceived in 2000, 2021 early, and then we actually launched it in 2022. One of the things at the time we were very focused on was we wanted to develop a kind of layer 2 platform whereby you had the flexibility to actually settle on different underlying networks. Because at that point in time, it wasn't clear personally whether we would be able to use public blockchains or whether it would have to be kind of a private network, which is kind of where we've operated thus far, just given the regulations. But what we've seen with digital assets, if we've worked very closely as a partner, is them obviously kind of developing the Canton network, and that is a public mainnet. And there's the kind of the whole tokenomics play. They've got the Canton coin, and we really kind of like how that's evolving. And so for us, naturally, as we think about kind of that ability to be active on a public chain once the regulations allow us to do so, for me, that's where we want to be active. And the reason we are obviously, and I've talked about this as well before, one of the reasons we want to divest the platform naturally is I think having platforms on balance sheet is very hard to scale. It's very hard to get that broad kind of institutional adoption. But whereas if you create something that's more market neutral with key market players who we're working with, I think that gives you the ability to really scale, accelerate adoption, and be interoperable with others who develop on the network as well. And I think that's a key point. So that's kind of the focus for us. And coming back to another point you made, one of the things that excites us about the platform is, we have from primary right through to post-trade. So you have the full life cycle of an asset. And I think when you start to layer in others doing the same, that's very powerful. So you have issuance right through to kind of, trading, distribution, and then post-trade.
And can you talk to me about the importance, last question on this, the importance of privacy in the network here? I have a little bit of a follow-on, but I'm just, why is that so important?
I think the ability to be able to transact and not have the whole network see who you're trading with, I think naturally is how we kind of transact today. And that's something that I think is, kind of a core ingredient across the financial market.
It's super interesting because privacy is one of these topics that it has always been maybe used a little bit against crypto in a way, because it's like, why do you need privacy, if you're not doing anything wrong? But it's very interesting to see. Blockworks has a couple of different conferences. This is our Suits conference, and we have a T-shirts conference, and the T-shirts are the blue-haired developers in Brooklyn. And it's interesting to see this converging, because if you were to talk to that group of people, privacy was maybe an original sin that we didn't get right in crypto. And so to hear you also be converging on that same point. currencies, equities. But there's also almost a barbell of, there's also been a push into private credit, where it seems like it's kind of the opposite end of the spectrum, and illiquid, higher yielding stuff. My sense is there's some issues which are like,
of people deciding to hold stablecoins perhaps than placing cash on deposit. This is more a philosophical discussion rather than anything else. But then how do you mediate credit to the market? One of the ways you'll do that is probably through investing in tokens. So that will be fund tokens, and then that gets kind of either an infrastructure fund, that could be a private credit fund, could be a mortgage fund. So you can see a way where there's also a different way that the market, kind of receives credit rather than just through banks. And that's possibly kind of something that'll happen, a bit quicker in the US than elsewhere.
Awesome. And then maybe a slightly spicy one to end on here, but there's been the Genius Act, which is passed in the United States, and one focus of that has been the ability to pass interest through to holders of USDC, et cetera.
Yep.
And there's been a little bit of resistance from the incumbents, which are the banks over there. And I'm just curious, from your perspective, I know Goldman isn't a commercial bank, but are stable coins an innovative technology that should strengthen incumbents, or is it disruptive, or a mix of both?
I think a bit of both.
Yeah. Okay, that's easy. Not that spicy.
Yeah.
Okay, well, this has been a ton of fun. If folks want to find out more about the work that you're doing at Goldman, or follow you, or just get in touch in general, what's the best way to do that?
Probably LinkedIn, in fairness. But I know a few faces here, but yes.
Excellent. All right, faces or LinkedIn.
Look,
This has been a ton of fun, Matthew. Thank you so much for doing this.
thank you very much indeed. Thank you.
All right,
Thanks,
take care.
everyone.
Thanks, everyone. Oh, everyone, please leave your headsets where they are. Some of you have been naughty and taking them out of the room, so please just leave them. Take care. Thanks. All right, everyone. I am coming here live from Das London. I'm joined by Michael Bentley of Euler fame. Michael, welcome.
Yeah, thank you for having me.
Good, strong name.
Good. You mean like the car? Like yeah.
No, Michael.
Oh, Michael. I think maybe Michael Bentley. Like, yeah.
Yeah.
A lot of people think maybe I'm related to the car company.
Yeah.
I'm not.
Okay.
So, yeah, good, strong name.
Thank you for clearing that
Michael,
up. That is
yeah.
what the users needed.
That's right. Yeah. So, yeah.
You come here for the hard-hitting content.
I do. Yeah.
Speaking of hard-hitting content, so we are coming to you live from the Digital Asset Summit in London. So my first question to you, Michael, is this the best crypto conference you've ever been to, or just the best conference you've ever been to?
I mean, it's the best. It's just the best thing I could ever wish to do in my life. Yeah, I'm having a great time. I'm exhausted. My voice is very gravelly because I've been doing a lot of conversing with the potential users of Euler, potential builders on podcasts and panels, and it's just been full on. But I've had an amazing time.
I'm glad to hear. Thank you for enduring 2 dad jokes here in rapid succession to start that.
Keep them coming.
Just out of curiosity, any takeaways? Like, I always learn so much talking to people at these sorts of events. Like, any takeaways from the conference or anything like that?
Yeah, I was just saying to your colleague before I came on, the very first DAS conference I came to was a good few years ago now, and for us it didn't feel relevant. Like, I'm being brutally honest.
Yeah, no,
there was just no connection really between people building in DeFi and all the institutions and the fintechs and the banks and everything, and that's just completely the opposite now.
Yeah,
I mean, it feels so relevant to be here. We're just getting it's an onslaught, and it's in a good way, right? It's a really nice problem to have. So yeah, it's just a sign of the times, really, how quickly things have changed. It's just a fantastic conference for us. Yeah,
that's amazing. I'm super glad to hear that.
Yeah.
Okay, so I would love to actually start. I'm a big fan of not bearing the lead here. I'm just going to jump right into it. I understand that you have an exciting announcement to make here. So talk to us. Get a little drum roll here.
Let's go for it. Yeah, fantastic. Thank you. Yeah, so we're launching a new product. It's Euler USD, a synthetic dollar.
Yeah.
As you know, Euler is today not just a lending protocol; it's also a DEX. So we have with this new product coming soon, we will have the Holy Trinity. We'll have the DEX, the credit markets, and the synthetic asset that people can borrow. It's still a few weeks out, so yeah, you can't use it right away, but it's going to be a really important part of Euler going forward. I think we're in a really great place to launch something like this. A lot of projects are obviously going down the stablecoin route at the moment, and they all need to integrate with credit markets. They all need to integrate with DEXs, and that's one of the main reasons Euler has grown to 4 billion in deposits, is because we have so much product market fit for those kind of assets. But ultimately, all of them have to pay for all the extra infrastructure that they're using. Right? They have to pay LPs and the protocol fees for other protocols. And Euler's uniquely placed to launch a product like this because we don't. It's all internal. So there's no value leakage outside of the system. So I think this is going to be a really great product for bringing more value to Euler token holders.
That's fascinating, and I'm super interested in this idea. I have a million follow-up questions for you, but for listeners. This feels like a really interesting continuation of there's some kind of buzzword, it might have been the curve wars or something, I can't remember back in the day, but at one point Curve, formerly Maker, now Sky, and Aave kind of woke up and looked at each other and said, we're actually all kind of doing similar stuff here, and the infrastructure that's required to power our protocols on the lending side or the stablecoin side, pretty similar. So maybe we should launch into each other's spaces, and that's how you got Go from Aave.
Yep.
It didn't really ever take off with CRV USD, but they also launched a stable-coin, and Maker, now Sky, is kind of an interesting mix of lending. They've got Spark and their stars, and they're obviously one of the OG decentralized stable coins.
Yep.
Talk to us about the synergies that you see here, and then I would love to build towards some of the cool new stuff that you can do with the stablecoin that might not have been possible before, product features.
Yeah, I mean, there's a ton of synergies here. I mean, one of the unique features of Euler USD is that you'll be able to borrow against a variety of different collateral, but at fixed rates. So there'll be a unique borrow rate per asset, which is really important because with a lot of other stablecoins where there's a singular rate at which you borrow, that leaves the synthetic asset vulnerable to being picked off basically by borrowers that recognize that it's too cheap to borrow than it should be, and so they borrow very, very aggressively, which can lead to instability in the peg mechanism. So this will be the interest rates here will be a unique composition of a kind of base rate, which can be used as a monetary policy tool, much like the Fed changes the base rate of the for the dollar, but then also a risk premium attached to each unique collateral type. So we're working on a partnership with somebody I can't talk about just yet, I'm afraid, but there'll be hopefully both crypto native collateral, so things like Bitcoin and ETH. There'll be real world assets. You'll be able to use Pendle PT tokens to borrow this synthetic. So yeah, on the borrowing side, very, very exciting. On the sort of lending, holding side, who's going to earn the yield from this asset? Well, we are able to use some of the existing tech we have to essentially create these markets across a multitude of different networks. So we're on 10 plus chains today. So you'll be able to borrow this asset across all these chains, but the yield will all flow back to a central yield hub on Ethereum, which is quite unique. That we have this one big, massive honeypot for yield, basically for the stablecoin as well.
And could you talk for listeners as well? I mean, this was it took a couple conversations with shout out to Adrian from Steakhouse and actually Sam from Frax, who pointed out to me in the early days the similarities actually originally between the infrastructure and the competencies required of running an LST and a stablecoin, and then eventually a lending market, right? So there's kind of this margining type infrastructure, needing to manage redemptions, sort of core competencies and similar infrastructure build. Like, talk a little bit about that, and then are you exploring with the stablecoin? I don't know if you can talk about this yet, but I remember with Curve, they were exploring kind of this idea of soft liquidations, where instead of liquidating everything after one tick, they kind of sold your collateral off into their stablecoin, and then they would actually sell it back with a little bit less due to fees. But it was better experience than some of these harder liquidations that we see. So.
I love that mechanism. Yeah, it's fantastic. Euler, the synthetic here will work much like the other assets on Euler. So Euler itself, the underlying credit markets were built with this maximally flexible design principle in mind. And actually the synthetic that we're building is kind of an extension of the abstract modules that we've built for the core credit markets. And so this stablecoin will come equipped with a liquidation mechanism that we have on Euler today for ordinary over collateralized loans. The way that our liquidation mechanism works is effectively when a user becomes unhealthy, as they become more and more unhealthy, the liquidation bonus that they pay to the liquidators rises slowly over time. And what this means is there's a kind of a Dutch auction at play for the liquidation bonus. And to give you an example of why that's so important and why it's so effective as a mechanism, we had during last Friday when there's a little bit of market turmoil. Was there on Friday? Do you remember that? Yeah, it was old, ancient history now. There was we had one large user on Euler that got liquidated. Unfortunate for them, but fortunate for them was that they used Euler and not other platforms where liquidation bonuses are often 5% plus, sometimes 10%. On Euler, they get liquidated with a bonus less than half a percent. And that's because that was all that was needed during those market conditions to make the liquidator profitable. And so, new synthetic will come equipped with that same high quality, I think arguably the best liquidation system and most efficient liquidation system in DeFi today.
That's fascinating. I'm excited to see it live and in production. One question that I have for you is, do you have a plan for distribution here? I know Go, for example, has maybe struggled to take on the scale that, although now shout out to Blockworks dashboards. Actually, we have a great dashboard of Go and the income there, and it's actually generating a pretty significant amount of income now for Aave. But they have struggled maybe with the amount of distribution that they would have liked, and it's taken a little bit longer. How do you plan to do that from the lending platform? The DEX.
Yeah, great question. I mean, the DEX is a really crucial part of this. Any new synthetic you launch, the major challenge is, where does the liquidity come from? How can people exchange it? They need to often, the main use case is you borrow it and then almost immediately sell it, right? So you need to be able to handle that sell pressure in order to maintain the peg and in order to make the product useful. Euler's uniquely placed because of Euler Swap, which is another product we launched earlier this year, which is a swap protocol that's built on top of the underlying credit markets as well. So you can see that how we sort of stack things up here. We have really core solid infrastructure with the credit, and then we have the DEX, and then we have synthetics on top. So what Euler Swap does uniquely is it provides exceptionally deep liquidity for stable coins and very, very efficient liquidity mechanism. So the synthetic will benefit from that. We'll have very, very deep liquidity for the synthetic on day one. It won't be something where we need to go out and try to bootstrap liquidity by incentivizing LPs or recruiting professional market makers. There's a huge amount of value leakage there, which then restricts how big the asset can grow. If you have a synthetic there's only a few $1 million worth of liquidity on these DEX markets, well then there's not too much you can do with it. People can't borrow it too much because they just can't exit it, basically. So yeah, key part of distribution is the swap.
Fascinating. Well, I'm very excited for this, and congratulations.
Yeah, thanks. We are too.
Yeah. One actually last question for you here. I was listening to the panel that you did here, and there was some talk about RWAs and maybe bridging the world of RWAs and how you'd manage something like liquidations. Euler has a very modular design, and you've kind of kicked some of the design and risk up to your curators.
Yep.
Do you expect RWA design vaults with their own specialized set of curators to be a bigger part of the business going forward into the future, or what do you think?
100%. Yeah, I mean it's growing quite quickly. Euler was the first lending protocol to house BlackRock's tokenized version of BlackRock's Biddle Fund. So that launched like several months ago, and we're seeing more and more real world assets coming on chain. I think there's going to be a lot of private credit that comes on chain. These assets pose unique challenges when it comes to liquidations, I think, because they often don't have DEX liquidity. And one of the principal ways that people, when assets need to be unwound, positions need to be unwound, especially in liquidations, is that you need to be able to sell them back for dollars or for whatever the debt asset is that needs to be repaid. And yeah, this is another area where Euler Swap can actually help. We have this feature called just-in-time liquidity on Euler Swap, where if you were the LP and let's say you had some small amount of margin in a particular real-world asset, if I wanted to exit a real-world asset and there's no liquidity on Uniswap, what can I do? I can actually transfer and swap in the real-world asset to yourself. You would then add it to your existing collateral, and then the aggregate of that, the total collateral, would then be used just in time to take out a loan of dollars, let's say, or USDC, USDT, and that would be sent out to me. And so this operates very much like an instant redemption mechanism. The difference is, obviously, from my perspective, I just swapped a real world asset for dollars, which is great for me. For you, well, you just sent a chunky swap fee because your margin may have been only $1 million, but you might have just facilitated a swap of 20 million. So you can get at least very, very chunky swap fee. The challenge then is for you is you're then left with an open position. Have lots of real world assets. Yeah, exactly. So this is something that I think this is where professional market makers and OTC desks and others come in. If this was done, Friday night, when all the desks are closed and the market maker then has to hold that position maybe over the weekend, and they can then slowly unwind it when the market's open the following week. So yeah, from their point of view, they're doing it. They're perhaps hired by the asset issuers themselves. We see a lot of demand for that from asset issuers. Maybe they're doing it for purely profitable reasons, though. Like this, if the swap fees are greater than the cost of borrowing or the risks that they're taking by holding this position, then it justifies itself in its own right. So yeah.
What about for some real world assets that have longer duration profiles? Is there more of a challenge there? Do we need to see more specialized market makers that are comfortable holding that on their books for a longer period of time?
Yeah, absolutely. I mean, one of the key ways that you normally liquidate in DeFi, or historically, by essentially taking the distressed position and you immediately swap the collateral for the debt asset and repay. But that's not the only way to liquidate a position. You can also take, if you hold enough margin, you can just take the collateral and the debt onto your own balance sheet. So if we have a specialized market maker that's eligible to hold some of these trickier assets, let's say, then they can take that risk, hold it, choose to take it onto their own balance sheet. Now, at what price point should they do that? Well, it depends on market conditions, right? They have to themselves figure out whether that's something they want to do. And again, this is where the Euler liquidation mechanism is very useful, because we basically have this decaying, this bonus, which rises through time. And so if it's not profitable to do that at a 1% bonus, maybe it is at 2%. And so the liquidators will just wait until 2%. And at that point they go, yeah, I'll get paid 2% to hold this distressed position and close it out in 6 months.
I would imagine that funds that have the mandate that allow them to be comfortable, holding that risk on their books. I think, for the right type of fund, I could see that being super interesting.
Yeah, there's definitely a ton of ways to make additional money here. It's something that's all quite new though, so we're going to have to. It's going to be something that people scale into. It's a whole new business opportunity for somebody out there. But
Yeah, I remember I did a whole season with Dan Robinson on DEX design, and he describes in the early days of MEV, it was just too early for there to even be this group of folks who would pick up free money. You'd literally leave $10 on the sidewalk, and you'd hope that people would pick it up, and the arbitrageurs just didn't really exist yet. And now, that's a very, very competitive space, especially the sex to DEX arbitrage area. And I'm sure this is just one of those spaces like, hey guys, there's money here. Maybe it'll take a little while, but money doesn't get left on the sidewalk for long.
No, it doesn't. No, it will. Somebody will step in to fill this because it could be very, very lucrative. I mean, with these assets, the margins are quite small, but the scale can be absolutely enormous. There's like 80 trillion in the wider economy and only 80 billion or something in DeFi right now. So if some of those assets come on chain and you have big institutions, lending, borrowing billions at a time, then you don't need to make an awful lot on the percentage point to make a lot of money.
Yeah. Final, maybe as we start to wind down here, switching tacks onto the more personal note.
Yeah.
I think Euler has executed one of the most honestly impressive comebacks I have ever seen.
Thanks.
I can't even imagine how stressful, and I get it as a founder, right? You're all in the spotlight. So many folks, I'm sure, counted you out, and you've just painstakingly built the brand and the trust and the credibility back. And it's so good to see you guys winning again. But what was that like? I mean, I could kind of guess, but how did it feel?
I mean, it's been exhausting, right?
Yeah.
It's been kind of awful at times, but I mean, also exhilarating and rewarding. So like a big bag of mixed emotions, I think, from us and the team. There's something nice being the underdog at times. When people sort of rule you out and count you out of things, it's just not possible. When I hear something like that, that's like red flag to a bull. Like I'm just like, no, it is possible. So we're ultimately a really determined team. We have we've shown a lot of resilience. It's been a massive team effort, and it's been a really tough one. It's been very tiring, but we are delighted to see all the progress and everything, and it's really testament to the quality of the products, because if the product wasn't good, there would be zero way to do what we've achieved. So we've had this big baggage to carry around with us, and in spite of that, we've still managed to grow and on a shoestring budget as well. It's massive shout out to my team. I'm so proud of us. Yeah,
so impressive. I'm curious, did you ever think about changing the name? This is one of the things. Why didn't you?
Well, there was a big discussion about it. I think in the end, what won it for us was we thought, yes, we have this baggage, but Euler had a very strong brand name before that. It's very recognizable. It's terribly branded because no one can pronounce it, but because of that, it's kind of become.
We've got stuff no one can pronounce either. I remember saying I would never have anything that people can't pronounce, and then for DAS, people are like DAS, DOS. No one calls it the same thing. So it's DAS.
But what we felt is we didn't want to. If we just rebranded, then it might look like we had something to hide, and I really don't feel like we did. We're building a very, very challenging industry. Everybody that you've interviewed will have had issues. It's a very nascent technology and everything. And Euler, before, we had some of the real top security practices. We had very, very clean audits, multiple audits, big bug bounties. We were some of the earliest to experiment with formal verification on this. So we didn't feel like we had anything to hide. And so we decided we're going to own it, own the story. It's part of our history now. And so with that, let's just keep our terribly branded name. Yeah.
I think it's a very cool name, and it's a mathematician, I know, right? I'm not.
Yeah. Do you know why we're called Euler? Actually, I can tell you very, very briefly.
I'm outing myself as not having done all my research here, but.
So, if you want to earn interest, the best thing you can do is compound it, right? How do you earn the most interest? Well, you compound very frequently. The more you do that, the more it compounds, and the faster the yield grows. So if you compound instantaneously quickly, like every minimalistic second, you get to you end up defining something called E, which is Euler's number. And so Euler is the thing
that's a great.
Euler is the thing that maximizes your compound interest. So it's very tenuous. There's about 5, you have to get a degree to.
That's a great for the 5 math nerds out there. I'm
yeah,
sure they're
they love it. Yeah, exactly. So
that's awesome. Well, seriously, heartfelt congratulations. I can just imagine how much
thank you.
You would have worked to do that, and it's showing. And wish you all the success.
Yeah, thank you.
All right, I think that's about all the time that we have. Michael, this has been a ton of fun. If folks want to learn more about Euler, find out more details about the stablecoin that you're launching, or just get in touch with you, what's the best way of doing that?
Yeah, I would say Euler.finance is our website. You can find me on Twitter, Euler_MAB. The last bit is just my initials. There's not much about the stablecoin. This is you've won an exclusive here. You talked me into it.
There we go.
So there's not much out there yet about this, but there will be soon. So watch this space.
Excellent, Michael. This was a ton of fun. Thank you.
Great, thank you.